Welcome to this explainer. Today, we're diving into a pretty wild financial puzzle involving American Electric Power, or AEP. If you follow the energy and utility sector, you already know finding a clear signal in today's market can feel a bit like reading tea leaves. But AEP? They're flashing some seriously conflicting signals right now, setting up an absolute mystery for investors. On one hand, the stock is dropping, but on the other, the company's internal expectations are actually rising. So how do we make sense of this? Let's unpack the data and figure out exactly what's happening behind the scenes of this major utility player.
Okay, let's jump right into the headline number that's got everyone talking: 14%. AEP stock recently took a hit, dropping nearly 4% in just a single day, settling at $120.94. When you zoom out, that puts the stock almost 14% below its 52-week high of $140.58. Seeing a regulated utility stock slide that far from its peak, that definitely raises some eyebrows. At first glance, a double-digit drop like that looks like a glaring, flashing red warning sign.
Which naturally leads us to the big question. Why exactly is the stock falling? And more importantly, what does this mean for you? Is this a major warning sign pointing to fundamental cracks in the business? Or are we looking at a hidden buying opportunity disguised by some short-term market panic? To answer that, we have to look past the ticker price and dig into the actual performance data. Because as you're about to see, the underlying numbers are telling a surprisingly upbeat story that completely contradicts that dropping stock price.
This perfectly captures the contradiction I'm talking about. Take a look at these second quarter financial signals. We've got top-line revenue growing a very healthy 7% year over year, hitting $5.445 billion. The business is clearly bringing in more cash. But then you look at operating earnings per share, and they actually fell 4.9%, dropping from $1.43 down to $1.36. So revenue is going up, but operating earnings per share are going down. That's a conflict you just can't ignore. But hold on, because it gets even weirder. If you look at the Q2 GAAP earnings, the standard accounting principles, they plunged by a terrifying 41.8%. GAAP earnings per share fell all the way to $1.31. Now, before anyone hits the panic button, there's crucial context behind this massive 42% drop. AEP management focuses on operating earnings rather than GAAP earnings right now for a very specific reason. This drop was heavily skewed by some tricky year-over-year comparisons, specifically the timing of tax-related items and the prior year sale of a transmission minority interest. So it's absolutely vital not to look at that 41.8% drop and assume the core business just vaporized.
Actually, if we step back from just the second quarter and widen our lens to look at the first half data, the story shifts completely. While Q2 is definitely a mixed bag, the first half as a whole shows revenue up, sitting at $11.465 billion. And more importantly, those first half operating earnings actually ticked higher, reaching $3.01 per share. So the longer-term trend for the year is actually pointing up. And that brings us to the biggest plot twist of this whole analysis.
Despite that mixed second quarter, management dropped a total bombshell. AEP is raising its full-year outlook. They literally bumped the midpoint of their 2026 operating EPS guidance from $6.30 up to $6.40. And on top of that, they reaffirmed a strong 7 to 9% annual growth rate stretching all the way out to 2030. Think about that for a second. Companies whose fundamental businesses are falling apart usually do not raise their full-year guidance. This is a massive bullish clue that the management team is seeing something highly lucrative coming down the pipeline.
And here is exactly what they're looking at: 69 gigawatts. This is the real twist of our story. AEP has secured contracts for an enormous 69 gigawatts of new load additions through 2030. To put that into perspective, just one single gigawatt can power roughly 750,000 homes. So we are talking about a staggering amount of electricity demand being added to their pipeline. They previously reported 63 gigawatts, so this number isn't just big, it's accelerating. But where in the world is all this unprecedented demand for electricity coming from? Well, the crucial point here is that AEP is actually an indirect backdoor play on the artificial intelligence boom. We constantly hear about the tech giants, your NVIDIAs, Microsofts, Amazons. But let's think about the physical reality of the AI economy. It starts with AI chips, right? Those chips go into AI servers. Those servers are housed in massive data centers for cloud computing. Those data centers require mind-boggling amounts of electricity to run and stay cool. And finally, all that power has to come from the power grid. AEP doesn't need to invent the next big microchip to win here. They just need to feed the outrageously power-hungry beasts that run the AI revolution.
And AEP is already moving aggressively to meet this exact moment. To power this AI and industrial electrification boom, they've already secured 13 gigawatts of gas-fired turbine capacity, and they have another 10 gigawatts currently under evaluation. They are actively building out the generation capacity needed to fulfill those 69 gigawatts of future demand. This isn't just some theoretical pipeline drawn up on a whiteboard. This is physical hardware being secured right now. Now, while investors wait for that massive AI grid expansion to fully materialize, there's a very tangible benefit sitting right in front of us. Let's pivot to the income advantage for a second. Because the stock price dropped down to around $120, the dividend yield has become pretty darn attractive. Investors are looking at an annual dividend yield of approximately 3.14% at that entry price. This makes AEP a fascinating hybrid. You get the upside of tech-adjacent AI growth, but it actually pays you a solid utility dividend while you wait for it all to play out. And a quick look at AEP's history shows just how rock-solid that income really is. They maintain a steady beat of 95 cents per share quarter after quarter. That equates to $3.80 annually. The payout ratio sits comfortably around 65%. Honestly, this is exactly what you want to see from a defensive, regulated utility, pure consistency. It's a pretty stark contrast to high-growth tech companies that rarely pay dividends and can be wildly volatile when the market hits a rough patch. Of course, no explainer is complete without looking at the downside, so let's objectively break down the risks from our source material. First off, as we touched on earlier, Q2 operating EPS did experience a decline, and that's always something you've got to monitor. Beyond that, utility companies require massive amounts of capital, meaning interest rates and financing costs are going to heavily impact their bottom line. Another big hurdle? AEP can't just build whatever it wants whenever it wants. They need strict regulatory approvals to pass any costs on to consumers. And finally, on the valuation front, it isn't exactly a screaming bargain. Some estimates put fair value around $113, implying the current price already bakes in a good chunk of this future AI growth. Let's zoom in on that capital and regulatory risk for a moment, because this is where the rubber really meets the road. AEP has this massive $78 billion 5-year capital plan required to build out all this new infrastructure. But standing right in the way is the very real risk of regulatory disallowance. The source material gives a perfect example of this. Over in Oklahoma, AEP requested a $299 million rate increase to cover their costs. The resulting settlement? Regulators slashed that approval all the way down to just $73 million. So the question isn't just, will America need more power? The question is, can AEP build it and actually get regulators to let them earn an attractive return on it? Taking all of this into account, the source material provides a really helpful, objective investor scorecard. The strengths are super clear. Dividend, AI, and data center exposure, and its nature as a defensive business all score a very strong 9 out of 10. However, those regulatory hurdles we just talked about, plus the balance sheet risks tied to that heavy capital spending, pull the score down in those specific categories to a 6 out of 10. Weighing it all together, the overall rating lands at a solid 7.6 out of 10. It's a strong business with incredible tailwinds, but there are definitely a few heavy anchors it has to drag along the way.
So what is the final verdict from our source analysis? Neutrally reporting the findings, it breaks down like this. It's rated a buy at 7.5 out of 10, but specifically as a gradual accumulation play for income and AI exposure, definitely not a quick flip. If you already on it, it's a strong hold at an 8 out of 10, assuming you still believe in that broader grid growth thesis. It's also an 8 out of 10 on watch for those of you hoping the valuation dips a bit closer to that fair value estimate we discussed. As for a sell, there's currently no signal to sell unless the fundamental story, like their guidance, cash flow, or those massive data center demands, starts materially breaking down.
Ultimately, this explainer leaves us looking straight at the future of American infrastructure. The mystery of AEP's falling stock and rising guidance reveals a company caught in transition. They're spending heavy capital today to lock in an absolutely massive pipeline of tomorrow's energy needs. Seriously, remember that number, 69 gigawatts. Because as the artificial intelligence and data center boom accelerates, it's going to demand an unprecedented amount of electricity. The question isn't whether AI needs power. That is a certainty. The real question you should be asking yourself is who gets paid to provide it. Thank you so much for joining me for this explainer. Keep learning, keep questioning, and I'll catch you next time as we unpack another fascinating topic.